I'm Glenn Freeman for Morningstar, and in this edition of How We Invest Your Money, I'm speaking with BlackRock's Charlie Lanchester, who built their concentrated industrials share fund from the ground up, which has some quite surprising characteristics in terms of not holding any of Australia's big four banks and none of our resource companies. Charlie, thanks for your time today.
Thanks for having me.
Now, we're talking about Australian equities, and it's now about 3 years since you joined BlackRock to create this fund. And right from the start, you ruled out the big four banks and the resources, which are some of the biggest sectors within the Australian index. What's your decision-making behind that?
Sure, look, it was a great privilege to come to BlackRock, the world's largest fund manager, but with a blank sheet of paper, to design an Aussie equity product that I really believe in, and certainly one that myself and the team can all invest our money in with confidence. So that was really the starting point. We've ruled out resources and banks, as you have mentioned, and really there's a number of reasons for that. On resources, we believe that's very much a global sector, best analysed by people who are specialised in that field. In addition, we think over the long term, resources have been very volatile, and the companies that to run these businesses have not been particularly good investors of capital. And that's something we think about a lot when we buy industrial businesses. We're looking for management teams that reinvest capital wisely, and that really doesn't fit very, very much in the resource sector. So that's that. But secondly, then we did exclude the top 5 stocks by market capitalisation, which are currently the 4 banks and CSL. And really, this was around concentration risk, particularly the 4 banks. The last thing that an Australian retail investor needs, in particular, is me to go and buy them another bank share. They are overexposed to this sector, and not only through their bank holdings, often directly, but also through their investment properties, which is effectively the same trade. And it's a trade that we do see some risk in, and we might talk about that a little bit later. So we leave out those stocks, that's about half the market, and really focus on the other half of the market and try and uncover the next CSL, the next ResMed, those sorts of companies that can reinvest capital and grow over time.
That's interesting what you're saying there about the resources stocks, and there is a lot of short-term bullishness out there with commodity prices being as strong. But I mean, Morningstar's view, their analysts hold a similar view to you. Over the longer term, they're actually you can't just place a bet based on the fact that the iron ore price is high right now.
No, look, it's very difficult to pick, and I think really it's the commodity prices, as you point out, which drive the share prices. And we're just being honest and saying that we don't really have that crystal ball to predict those commodity prices. Maybe other people can do that, but we would rather just pick solid companies, putting money back into their businesses, growing more steadily over time.
You mentioned there about the concentration risk and how what your investors really don't need you to go out and buy another bank for them. They've already got that covered. How concentrated are Australian investors and how do you try to address that in your portfolio?
Well, look, we build a portfolio from the bottom up. We're stock pickers at heart. We run a very concentrated fund, 20 to 40 stocks, currently I think around 29 stocks. So we are having a go, and the top 10 stocks make up close to 50% of the fund. So we're very index agnostic. I mean, our view is that indexes are backward looking. They tell you which companies have done well over the last 20 years. We're trying to find the companies that are going to do well over the next 10. And so we are able to find some more interesting companies. Our top 10 holdings, when you look at them, and it's on the BlackRock website, will look very different to any other Aussie equity manager.
And so how do you actually go about picking the companies that make it into that portfolio? I mean, you've got to choose, like you say, between 20 to 40 companies.
Look, at BlackRock, we're lucky enough, by virtue of our index business that we have, to be on the register of every company in Australia, which gives us incredible access. Even though we're a relatively small, new and nimble fund, we are able to get in and talk to every company in Australia. So that's a huge advantage in a competitive space. In terms of the process, we are absolutely focused on not losing money. That is what equity investing is about. You have to first and foremost guard against the pitfalls. You have to avoid the blow-ups. And so we have an investment process that focuses on 5 quality filters, first and foremost. They are around management. They are around debt. We don't like businesses with lots of debt. They are around businesses that make a profit, which sounds simple, but there's a number of businesses that don't make a profit in the ASX 300. It must have a sustainable competitive advantage that we can easily explain. And we look at some ESG issues to avoid companies that really ignore environmental, social and governance issues. So that is at the heart of our process, and that excludes, maybe about 40 or 50 companies from the index that we just simply won't go near.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.